Is this a minor wobble for gold or something bigger? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Rick Rule, CEO of Rule Investment Media. Hey, Rick, it's great to have you back on.
Maggie, it's a pleasure to be back. Thank you for having me.
And hi to everyone who's joining us live on YouTube and Substack. Please be sure to drop your questions in the chats and we'll get to as many as we can. And remember to subscribe and hit the like button. So, Rick, you are a longtime commodities and gold person. I mean, you have forgotten more than any of us hope to know about these markets, and we're going to get to them in just a minute. But I wonder if we could start a little bit more broadly. And I'm curious what your sense or I'm curious to get your sense of what's happening on the macro level. We have Treasury bond yields moving higher, volatile, but sort of upward pressure on them in the US dollar moving lower, especially against Asian currencies. We've seen some really rapid moves there. Japanese bonds just hit an all-time high last week on the yields. It just seems like there's a lot going on underneath the hood. What do you make of where we are right now?
Well, the first thing that you talked about is, I think, particularly interesting. The Fed and the political class in the United States has been doing whatever they could do to jawbone rates lower. And by quantitative easing, you'll note that the Fed participated in their own auction last week. Uh, they've been successful in holding near-term rates lower, but they've lost control of the yield curve in the longer bond,
Mm.
uh, which is difficult for them. Difficult for them in many ways. The political class, of course, would like Americans to have access to cheap credit. At the same time, the US government has to roll over several trillion dollars worth of debt that they've been paying 2.5 on, and it looks like they'll have to pay 5 on it. If we're concerned about debt service, how are we going to feel about debt service at twice the current rate? An ugly circumstance. For a long time, the Fed appeared to have control of the yield. You have to go back to the Clinton era for the last mention of bond vigilantes, which is to say, the market regaining control of the rate rather than the Fed regaining control of the rate. This is a truly interesting circumstance. And I don't think that the fact that it's occurring at the same time that the US dollar is facing a challenge from other fiat currencies in terms of hegemony is any coincidence. I think they're part of the same phenomenon. The US dollar, and in fact, the US economy was really a hegemon in the period 1982 to 2022. And I believe, by the way, that the US dollar will be the reserve currency for the balance of my life. For the record, I'm a very healthy guy. But I think that the hegemony that we've enjoyed for the last 40 years is gone. I think that several things contributed to this. One, we simply became hubris ridden. Two, in the US economy, we built up too much debt. There's $36 trillion in on balance sheet liabilities at the federal level. That's a T. And the net present value of unfunded liabilities, Medicare, Medicaid, Social Security, federal pensions, military pensions, that number, the net present value, not the nominal number, is $100 trillion. To put that in perspective, the IRS says the private net worth of Americans is 141 trillion. So if you're worth 141 trillion and you owe 136 trillion, you begin to see the problem.
Mhm.
I think investors, bond investors, have figured out that the only way out of America's dilemma is to reduce the purchasing power of the US dollar. Hence, they want more current yield to, in some way, shape, or form, recoup some of the losses that they will experience from the depreciation, the purchasing power of the dollar over time in their bond yield. And foreigners feel the same way. While the US dollar was, and US treasuries were the undisputed king of global trade mechanism for 40 years, while we will continue to be the world's reserve currency, we won't have the same dominating force that we had in the past. Very recently, yields, both real and nominal yields, have gone up in Japan. There was a trade for 40 years, a carry trade, where you bought artificially depressed, you borrowed in artificially depressed yen, and you invested in US dollars. That trade's unwinding as the Japanese interest rates go up. Hence, the Japanese yen is increasing.
Mm.
Renminbi is increasing. What we're seeing is a reduction in U.S. hegemony, and we're seeing a change in market condition from the market that existed in the period 1982 to 2022 to a very different circumstance, one that's much more challenging.
Yeah. Akash asks, when I'm thinking about, well, before I ask that question, Akash, the Fed has lost control of the bond market, at least the long end of the bond market. Does any central bank control their bond market anymore?
I'm not sure they do. I mean, the Brits lost control, in effect, of their capital markets when George Soros and Jimmy Rogers and all those guys staged the famous raid on the British pound in 1990. I wonder. It could be that the Chinese, because of their savings, control some aspects. And we probably could have controlled our bond market if we weren't such profligate spenders. The world wanted US dollar hegemony. The
Mm.
world wanted the US Treasury to be a good deal. The world did not want the US government to try to extraterritorially impose US power in other countries through the SWIFT banking system. Whether or not the world liked the actions of Russia in the Ukraine, other societies looked askance when the US government stole $300 billion worth of Russian assets in US Treasuries. It didn't. It didn't give other people who thought that they might have a dispute with the US government much confidence in the security of their US dollar holdings. So the circumstance that we're going through, while interesting, was easy to see coming. And in fact, you and I talked about some of these things as long ago as 2 years ago.
We did. When you said everyone is under allocated to gold
Right.
because of this, which turned out to be incredibly, prescient and early, but it's a market that you watch closely. So Akash was asking, do you think this is stagflation or is this a 1920 style collapse? And I'm just going to say, I usually resist and sometimes don't read. There's always somebody who thinks the world's ending, but Akash, I understand why you're asking that because frankly, I've been interviewing people who tell me that too. And so, and how that can spread, Rick. So how do you sort of, is there a way to get out of this without seeing some sort of massive financial event?
It depends on what you describe as a massive financial event. I went through the decade of the 70s, and I think in that sense, past is prologue. That was challenging. We got through it, and we're going to get through this. But there's going to be a reckoning. With the obligations that the US government has, there are two ways out. You can have an honest default. That takes you right straight to the 1930s. It's pretty ugly. Or you can have a dishonest default. And that's what we're going to do. We're going to have a dishonest default. In a dishonest default, you honor the nominal value of the obligations. You tell some old geezer named Rick Rule, yeah, we promised you $4,000 a month in Social Security payments, and you're going to get it. It's just that we're going to devalue the dollar. So your $4,000 is going to buy you $800 or $900 worth of goods and services.
Mm-hmm.
Becky, we did this in the decade of the 70s. According to the Congressional Budget Office, the US dollar lost 75% of its purchasing power in 10 years. And I think that's what we do today. Yes, we fiddle around the edges. We look at Social Security and we say to some rich guy like me, we're going to means test it. Because you don't need it, you're not going to get it. And we're going to raise the eligibility from 65 to 70 or some number like that. That makes perfect sense too. When Social Security was instituted, the average life expectancy of an American male was 66 years. So we insured him for a year. Now the average life expectancy of an American male is something like 81 years. So we got to raise the eligibility. And we're going to axe the cap, which is to say rich people, despite the fact that they aren't going to get paid, are going to pay tax on their full income rather than the first 160. But that's not enough. It doesn't matter fiddling around the edges. What we're really going to do is what we did in the decade of the 70s. We are going to devalue the US dollar. We're going to reduce the purchasing power, and we're going to reduce it by a lot because we have no second choice. Let's do that original math again. As individuals, we Americans, according to the IRS, are worth $141 trillion. We owe 130, pardon me, we owe 36 trillion to bondholders, and we've promised $100 trillion to entitlements beneficiaries. That doesn't leave much margin, 141 minus 136. But it gets worse. The on-balance sheet liabilities of the US government grow by $2 trillion a year, and the off-balance sheet liabilities grow by $2 trillion a year too. This is decidedly bad arithmetic. And the only way that you do it is by sleight of hand, by reducing the value of the denominator, by reducing the purchasing power of the US dollar, precisely what we did in the 1970s. So I think in answer to the question, stagflation is very likely. I think collapse is unlikely, although I would be surprised if in the next 10 years we didn't have a liquidity event that reminded us of, say, 2008. I'm not saying it's going to happen, but I would be surprised over the next 10 years if it didn't. By the way, that just resets prices. It doesn't change much. You know, if you think about the fact that you have a building, and the building on Monday is worth 50 million, and the building on Wednesday is worth 25 million. The building didn't go away. Its utility didn't go away. Its service to society didn't go away. None of that went away. What went away is the equity that the owners had. It's important to them as opposed to society. That's what you have to understand with these liquidity crises. They either work for you or work against you, depending on how you've organized your life. And
so let's talk about what works for you, because I think this is where, and I'm gonna bring up Bitcoin in a minute, but so how does gold work against that backdrop?
Well, let's review.
Is that part of what can make it work for you?
Sure. Let's review the 1970s. In the period 1970 to 1980, the US dollar lost 75% of its purchasing power, and the gold price went up 30-fold. I'm not suggesting to you, by the way, that the gold price is going to go up 30-fold. What I am suggesting to you is that the nominal appreciation in the gold price will, in effect, likely mirror the depreciation in the US dollar. I don't have time to tell you why the gold price won't go up 30-fold. Suffice it to say, I don't think it will. But I think that it will roughly, meaning the gold price, will roughly mirror the deterioration in the purchasing price of the US dollar. During periods of time when savers are concerned about the maintenance of their purchasing power in fiat-denominated instruments, those are the times in history which gold has done best. And investors have a lot to be concerned about right now.
They do. So this is where the Bitcoin question becomes interesting, because I think and I think a lot of people feel you when you say a return to the 70s. I mean, some people are worried about the 20s and 30s. That's even more severe. But certainly, I think on a gut level, I think Paul, even though you're in the UK, just said, you know, we've all noticed the rapidly reduced purchasing power of the pound. I think certainly many people listening feel like your money's not going as far as it did before. You know, it's whack-a-mole in terms of where that's showing up. Certainly not mirrored in the traditional economic numbers, but people feel stretched already. But then you want to say, well, what's different now? I'm always thinking about what could change that conversation. And certainly technology is one of them. And now you have this, you know, the development of these cryptocurrencies, really blockchain and utility. Is it possible that somehow that changes the scenario this time, and therefore changes the relationship of gold or the performance of gold against that sort of stagflationary 70s backdrop?
I hope so. I'm a consumer of currencies. I save in Canadian dollars a little bit. I save in currencies that I use in my day-to-day life. And the idea that there's a whole bunch of young rocket scientists out there trying to develop a new currency to serve me is, I think, a wonderful thing. I don't understand Bitcoin well enough to save in Bitcoin, but that doesn't mean I never will. The utility of Bitcoin, I get. I get that it is an asset that isn't simultaneously somebody else's liability. I get that through technology, It has the ability to become effectively frictionless. By the way, it's not right now. The fees are there and they're not frictionless. And I get too that it has the ability to be anonymous. The Bitcoin proponents, however, want it to be regulated so it becomes more effective, which to me takes away most of the utility.
Mm.
I save in gold because I'm experienced in gold. Part of savings utility is that it enhances one's sense of personal well-being. Because gold has served me well and because I understand gold, I'm comfortable saving in gold. I'm not comfortable personally saving in Bitcoin. It's interesting, the discussion that you posted from the person in Great Britain where they talk about the price of things in pounds.
Mm.
I've maintained an alternative private ledger as a thought experiment for my own income statement and balance sheets since the year 2000 in gold. And when I measure the price of goods and services in gold, I'm astonished at how cheap things are. The gold price has gone up 12-fold in the period 2000 to 2025. And although prices have gone up, mostly they haven't gone up 12-fold. So when I think about buying a restaurant meal in dollars, the restaurant meal seems expensive. When I think about buying a restaurant meal in gold, gold seems very cheap. And Bitcoin has outperformed gold by a country mile because I don't understand the total value proposition with regards to Bitcoin. Rather than be excited by the fact that it has gone up since the time I've watched it from $10 to $100,000, rather than be excited by that, I'm terrified by it because I don't know how to establish a value for it. Its very performance for me, given my own lack of knowledge, is scary as opposed to exciting.
Mm.
Whereas I have, in effect, lived my life in gold since I was in my 20s, and I'm extremely comfortable with it. So for me, having gold as a component of my savings allows me to sleep nights and stay calm based on experience, where Bitcoin might fulfill that role for somebody whose life experience had been different than mine.
Yeah. That's so well put. And this is the very definition of a sort of knowledge seeker, which I know you are, Rick, because you're doing the work, you're understanding it, you're figuring out, how it intersects with you, but it's on the table, right? You're saying right now, I need to know more. It needs to have a different track record. I don't understand it enough, but it's not a complete dismissal of an asset class, which you hear a lot. And I think that's where I love that sort of posture. And I think that's where we all need to be living. And I have my own questions and, things that I'm trying to work out there, but you could see that whole new emerging innovation, right? Financial innovation is
Right.
going to come because someone's going to look to solve some of these problems, but what it looks like, I think that's different.
Well,
Um,
one intersection that's of interest to me is I've done a lot of work on the distributed ledger and blockchain, which is different than Bitcoin.
mm,
Uh, and I believe within 2 years that we will have fully digitized gold, that you'll have deposit receipts that are on the distributed ledger that represent real, not fractional gold that are redeemable. I think that the intersection of the distributed ledger and gold fulfills a need for somebody like me who likes the good part of the distributed ledger technology, but feels more comfortable with a tangible as opposed to a network asset behind it.
mm, yeah, that's super interesting. Um, 2 years. That's a pretty short time frame. So, is there something right now that would that digital gold make gold uh easier, the transaction easier? I think one of the hurdles in front of people, and we talk about this all the time, if you're a repeat viewer, it always is good to check in, because I always ask Rick, okay, you're a gold bull. We understand that. Your reasoning makes sense. How does an average person express that? What does that look like in my portfolio? Because
Right.
you have tools at your disposal that I do not. You understand the market in a way I do not. So I'm back to that question, is an ETF adequate in this kind of environment where we could have a liquidity crisis? Doesn't everything get sold off in that? And am I exposed, even though gold should perform well, am I exposed depending on how I choose to hold it in my portfolio?
That's a whole bunch of questions.
It is.
Let's answer the last one first. If we have a 2008 style sell-off, everything falls because for varying lengths of time, by the way, the high quality assets bounce back very quickly. But the decision to sell in a liquidity squeeze isn't made by the investor, it's made by the margin clerk.
Yeah.
And he or she doesn't care whether you like the asset or not. They're just looking for an asset that has a bid. So will gold sell off in a liquidity squeeze? Yes. Will Bitcoin sell off in a liquidity squeeze? Yes. Will stocks sell off? Yes. Will your house sell off? Yes. Everything will sell off. The assets that come back quickest are the assets that have the greatest utility. The second part of, or pardon me, the part of your question that preceded that part had to do with the function of gold. Traditionally, gold has been, among other things, money. It has been a mechanism for transfer that was also a store of value, which is interesting. It's become less important as a mechanism for transfer because it's been replaced largely by fiat currencies. The digitization of gold allows you to use a fraction of a gram to buy a cup of coffee at Starbucks and not have to have change made for you in gold.
Mm.
Hugely important. It allows Starbucks to aggregate all of those fractions and surrender them to an agent for physical gold if they want to, not for promises, but for the real thing. And you can get, by the way, a gold denominated credit card right now, but the transaction costs are very, very, very high. And the transaction costs for gold shouldn't be higher than the transaction costs for Ethereum, which can be, provided that you understand how to use it, very low. And what this means is that gold, in addition to being a savings mechanism, again becomes a retail transactional mechanism, not merely a transactional mechanism between the Central Bank of Russia and the Central Bank of China, but rather a transactional mechanism between Maggie Lake and Rick Rule in very, very low denominations. And that's a real game changer.
That's a huge game changer. Do you need Bitcoin if you have digital gold?
If you like Bitcoin, the beauty of Bitcoin is precisely that it doesn't represent fractional ownership. The beauty of Bitcoin is, as an example, if you live in Zimbabwe and your government wants to steal your wealth, you can use Zimbabwean currency to purchase Bitcoin, transfer the Bitcoin to some friendlier jurisdiction, and leave. In the case of gold, it is tied to something tangible. Governments love to steal things that are tangible. The beauty of Bitcoin is that it doesn't exist in effect. It is a ledger, and you can transfer a ledger, at least with current technology and current regulation, in a way that the people who would like to steal your assets find extraordinarily inconvenient.
Yeah. Great distinction. So a lot of people are looking. So we were talking very big picture here. So let's sort of shrink it down a little bit in terms of time frame, because that's super important. So there are a lot of people that are very, very the arguments that you make, the rationale you lay out, very attractive to them right now. They're really concerned about preserving wealth or finding a safe haven in this environment, but they feel like they've missed the gold rally, or they're waiting for an opportunity to buy it on a dip. In this kind of environment, does it feel like we could rally and then pull back with an opportunity to buy a dip? Or does this kind of feel like it's off and to the right and you're just going to have to pay the price in order to increase your exposure?
The answer lies with the individual. If one is a trader, I'm not uncomfortable with the fact that the current move in gold is overextended. I'm not. I save in gold. And my reason for owning gold is because I believe that they will devalue the US dollar by 75%. I have measured my purchasing power in gold occasionally since the year 2000. The gold price is up 12-fold since the year 2000. I answered the question, Maggie, by asking myself a different question. Rick, what would cause you to sell your gold? That would cause me to believe it was overpriced, right? That I
Yeah.
would have to sell it. So what would cause me to sell my gold? Well, I would have to see a balanced federal budget, first of all. And I would have to see a plan worked out, a fiscal plan that allowed the US government to politically deal with the entitlement liability. There's $100 trillion in net present value of unfunded entitlements. I would have to see how that problem resolved itself. Further, I would have to see real interest yields in US Treasury securities. If you believe that inflation in the United States is measured by the CPI at 2.5%, and you're getting a 4.5% yield in the 10-year Treasury, you feel pretty good. You're getting a 200 basis point real yield. If you believe, like I do, however, that the decline in the purchasing power of the goods and services that you, Maggie Lake, buys, then you believe that the purchasing power of the US dollar is declining by 7.5 or 8% a year. If you're getting paid 4.5 in a currency where the purchasing power is declining by 7.5, the US 10-year Treasury makes you 3% poorer every year for 10 years. Nothing could make me more concerned about the maintenance of my purchasing power than a guarantee that I was going to lose it. So, what would cause me to sell my gold? A balanced federal budget and prospect for more of the same. A mechanism for paying down the federal debt. A mechanism for dealing with the unfunded liabilities of the US government, and a positive real interest rate. That combination, um, the idea that those four things will occur anytime soon seems unlikely to me. The last time that we experienced that circumstance, not coincidentally, was the decade of the 1970s. It took an increase in the nominal interest rate, a fourfold increase in the nominal interest rate, a vicious recession, a repricing and reset of entitlements to deal with that. The next 10 years is going to be interesting. We're going to get through it, by the way. We have a lot of advantages, particularly technological advantages, that we didn't have then. We have an extremely innovative society where, 6 or 7 youngsters can get together and commandeer a garage in Sunnyvale, and out pops Google or out pops Apple, something that makes progress much less capital intensive. But it's going to be interesting. There's going to be a reckoning getting through from here to there. The ability that you have to forestall your own sense of responsibility for your future, that's over. Maggie, if you're your age, and you think that you're going to enjoy the same entitlement benefit that I have enjoyed, you're delusional. The money isn't there. You have to plan for your future, and unfortunately, you have to plan for funding mine. My generation voted ourselves all kinds of cool benefits, and we forgot to pay for them. So you get to do it, and you need to incorporate that into your planning for the future.
That's it. That's a lot of harsh reality. And you can see the blowback when people say that. People almost fell over when Elon said that it was, basically a Ponzi scheme, Social Security. There was a huge outcry, but he was just talking about, in some ways, the math that you were talking about. A couple questions coming in. Kirk, great question, Kirk. If utility of an asset is key, what are your thoughts on uranium?
Well, after 3 decades of underinvesting in uranium still provides 14% of the US baseload's power. Right now, the uranium price is hovering at the incentive price needed to produce it, while lots and lots and lots of countries are beginning to compete with us for the ability to consume uranium. This one's fairly simple. Without a viable uranium industry worldwide, the lights go out. There's a lot of utility to having lights. Another thing that I really, really, really like. Oh, you know what? I've got to be somewhere else right now, Maggie.
Okay, that's
So I'm going to
fine.
have
We got a hard out. That's like dun dun dun. Before you go, Rick, this is why he's the business man of the world. He's launching a bank. Rick is having a symposium in Florida in July coming up. It's going to be 4 days of some really great talk around all of the things we just touched on. We put a link in the description and in the chat if you would like to attend. And then you get a chance to talk to Rick himself, which would be
and
wonderful.
I'll make my pitch about that really short. We're the only investment conference in the world that offers you this. Whether you attend live or live stream, if for any reason you don't think you got your money's worth, I'll give you your money back. Absolute ironclad money back guarantee.
It doesn't get any better than that. Rick, we always feel like you leave us wanting more, but you'll come on again soon and we'll talk before your conference.
I look forward to it. Thank you.
Right. Thanks so much. And thanks to all of you. Take care. Good luck out there. We'll see you again soon.